Hi, I'm Shiloh Bates, and welcome to the CLO Investor podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. The views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates.
Today I'm speaking with Laila Kollmorgen, Global Head of CLO Tranche Investing at MetLife Investment Management. We discuss her approach to CLO investing and the multiple products her firm manages. You'll hear that Laila thinks CLO equity is cheap and that she also sees good value in junior BBBs and AAAs. Some housekeeping items. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. I recently put out a YouTube video and white paper on why private credit CLOs, but you'll hear during the podcast that Laila prefers broadly syndicated CLOs. If you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Laila Kollmorgen. Laila, thanks for coming on the podcast.
Thank you very much.
So how did you end up in the CLO business?
Yeah, that's always a fun and exciting one. For me, it's the culmination of well over 30 years of being in fixed income, really. I spent time on the buy side, on the sell side, been in the US and in Europe, structured products. I started off actually in emerging markets. So nobody would say, oh, starting off in emerging markets, you're going to end up in CLOs. So it was a little bit of a path. But I went to Merrill Lynch after getting an MBA. So I was in New York City and started doing structured products there, a lot of securitization. I ran the mortgage options trading desk there and then moved over to Europe. I worked for BNP in London. And there I started taking a look a lot more at CLOs and running their US and European CLO desk. So over time, I've had a lot of experience with US and European structured products and CLOs since 2003, actually.
Oh, wow.
Yeah, I feel very old at times. My running joke is that if it has a cash flow, it's got collateral, I can figure out a way to analyze it.
Well, I started in the CLO business working as a credit analyst in 2000. It's been a long go.
Exactly.
What's like one or two interesting things about CLOs that's kept you engaged or focused on this asset class?
There's always something slightly different. I guess for me, when it comes down to the bells and whistles of taking a look at a structured product, there's always fun things you can tweak. Traditional types of securitizations, you're going to take a look at running vectors on defaults or recoveries, the timing of those defaults and recoveries. There may be certain subsectors that you can tear apart and analyze. What's fun about CLOs is the transparency. And that's very, very different than what you find in, say, an RMBS deal or CMBS deals or other types, even an ABS on securitizations. Those are pools that you're taking a look at. In the case of a CLO, the difference is the transparency. It's the fact you can actually look at the collateral. You can say, okay, I happen to know these particular credits. I can understand them. And therefore, you can analyze where the risk is coming from in a very precise way.
Maybe just give us an overview of your platform. And you're a CLO investor. You guys also manage CLOs. Tell us about PineBridge.
So a couple of different things. PineBridge was acquired by MetLife Investment Management, and that acquisition closed at the end of 2025. So we very much are part of the MetLife platform. Just want to kind of bring that out there. And what this means for us is that it's a little different. MetLife Investment Management has been a significant investor in the CLO space. And for a very long time, they've got about $8 billion in AUM on their own side. We've got about $6.5 billion in AUM invested into third-party CLO tranches. What attracted me to PineBridge very specifically was the fact that they issued CLOs. When I joined 11 years ago, I was coming from this background of advising banks on their US and European securitization investments post the GFC. So I had a very, very specific idea how I wanted to analyze CLOs, and that was due to their transparency. I knew PineBridge from their US and European CLO platforms. They had begun issuing and managing CLOs in the US in 1999 and Europe in 2006. And they've issued 43 CLOs since. That is a very rich and very long history. So there's a lot of institutional knowledge through various different market cycles. What's nice about this integrated PineBridge MIM leverage finance group is the fact we have 19 credit analysts. And you know yourself from that background of being a credit analyst, it is absolutely vital for understanding the risks in a CLO, that ability to really look at it. So we have that as part of our process. It's that integral process, and it's this bottoms-up analysis, which we apply to every single CLO investment that we make. That is very much how our approach differs. It's the fact that we actually re-underwrite a portfolio. And when we're mapping that to our internal system, it does allow you to do that loan by loan analysis, really assigning a probability of default and a recovery. And that is actually one of the fun parts, as you know, about investing in a CLO, is saying, okay, I've taken a look at this portfolio and I really can get a very good feel as to where the risks are going to be.
Sounds like when you're analyzing third-party CLOs to invest in, that you're mapping the underlying loans to the credit opinions that you guys have internally. But obviously, they're a third party, so there's not going to be 100% overlap, and there's not going to be agreement on a lot of credit. What's kind of like close enough in your mind to a loan pool that would be approved on your platform?
There's a couple of different things. Everyone starts out with looking at the CLO manager. So we do our due diligence on the manager, and you can take a look at the performance of their CLOs on a historical basis. So that's fine. Everybody does that, and we tier the managers, et cetera, and we take a look because it comes down to security selection, portfolio construction, risk management. Those are the three tenets. So what we try to do when we're looking at that portfolio is we do minimize, to your point, the number of credits that we are not following. Part of it has to do with the natural way of you can't actually maintain coverage of the entire high yield and leveraged loan universe. You just don't. But one of the things we really focus on is the broadly syndicated loan universe. Because our issue is once you get into that upper middle market of private credit type CLOs, there you're just drinking the Kool-Aid of that manager. Because all you can do is trust. It's a trust me exercise. And as long as you're happy to do that, and as long as you're happy to provide term financing to investors actually that are in the equity, that's fine. But we don't find that that's a good use of risk. We don't feel that you're really adding any particular value. You're drinking the Kool-Aid, that particular middle market manager is serving you. They're receiving term financing for their portfolio, which is absolutely fine. That's the investment thesis. But for us, the broadly syndicated loan universe, to your point, you can't cover it all. And as a result, we do take a certain percentage that says that we're comfortable enough that it's not going to be too material. But when we do the analysis on the portfolio, and if it happens to be a credit that we don't have active coverage on it, what we're going to be doing is taking a look at the industry and the rating agencies' recovery rates and applying it to that. So we take a determination based upon price to some extent, and that has to do with where the leveraged loan index is currently trading at. And if it's trading at, let's call it a discount of 10 points, then the weighted average price for the leveraged loan index is going to be 90. So we'll take a look at determinations from 80 to 90 and then say from 70 to 80. So we do take into account just the average price of the leveraged loan index and then take a look, as to where we are going to apply a probability of default and then, of course, what that eventual recovery rating would be. So it's going to be a blend of rating agency recovery rates as well as market price.
So what are some of the products that you guys manage?
We have two CLO ETFs and we have an interval fund. So we work with Van Eck, where we are the sub manager. So we launched CLOI, which is an investment grade CLO ETF that was launched 4 years ago. AUM there is about just under 1.4 billion. And then CLOB invests into AA to BB rated CLO tranches. We launched that in September of 24. We're about 180 million in AUM. And then just over a month ago, we launched an interval fund that is focusing on triple B, double B, and equity tranches, and that was launched with 25 million in AUM.
So for a mandate where I think you said was it AA to double B?
That's right.
There's a lot of different risk profiles in that pretty broad mandate. How do you think about like if it's weighted more investment grade or more weighted to like double Bs?
Obviously, market conditions, but a lot of it has to do with the liquidity that you need to provide. ETFs have daily liquidity, so you need to be very, very thoughtful about that. I think that when you have products that are really focused at just the triple B and double B in an ETF format, it's kind of the wrong product, really, for an ETF. Because when you have a sell-off in markets, triple Bs and double Bs are the ones that really actually widen very quickly. And it's a negatively convex investment situation because you're having to sell, if you get a redemption, you're having to sell when the market's trading down. And that's not really a place you want to be. When we came up with the concept of a AA to double B, it was about providing an enhanced yield product than the investment grade product, but also because it's an ETF format, it has to actually provide daily liquidity. And AAs are fantastic. They really do allow you to provide that daily liquidity. You can sell billions every day, and you're going to be absolutely fine and get a 99 handle price when you sell. That's the lovely attractiveness about having a product that has AA, single A, is kind of the liquidity portions of the cap stack, and your triple B and double B, which are going to be your yield enhancement.
And then in the interval fund, you said triple B to equity. How are you guys weighting the opportunity there?
Very similarly to the ETF, but different. The interval fund doesn't have to provide that daily liquidity. In the case of, say, CLOB, what we do is we rotate down during times of market dislocation and add more triple Bs and double Bs because that's where you're able to add value. It's a market sell-off. So if you look at the historicals, equity tends to be a vintage product for the most part. Just like you find in private equity or maybe even private credit, real estate, they perform well during specific vintages. In the case of, say, 2020 or 2022 and parts of 2023, there was the PO effect from equity. You were able to invest and you could put together a portfolio at a discount to par. You captured that discount to par, boom, the PO. So that was fantastic. So that's one way that equity really performs well. 2025 was not the year, and 2026 has not been the year so far. That's fair. The other time that equity actually performs is after a year in which prices have gone down, not just because of the PO, it's the subsequent fact that spreads have actually widened. So when spreads widen, it's also another fantastic time to go in that subsequent year performs very well. So 2021, equity performed very well. If we take a look at 23, it performed very well for that reason. It performed okay in 2024, and then 2025 was pretty much flat. 2025 is an awful vintage, and it didn't perform very well. And you have a lot of investors that kind of looked at 2026 and just went, okay, we're done. We're tired of this. It hasn't been giving us kind of the north of 10% yield that we were looking for. And as a result, May alone saw almost $2 billion in equity trading in the secondary market. That's a huge amount. It was a huge amount. As you know, there were also captive equity funds that were looking at trying to recycle their positions and were selling minority equity. So we saw several platforms which were doing that. And at a time when we are ramping up an equity fund, or certainly an interval fund, which can purchase equity, we like purchasing portfolios that we can see. So we can re-underwrite that portfolio, look at it, really have a variety of different stress tests, as you can imagine, that we're looking at it and we're going, you know what, that actually looks good to us. That's where we're able to pick up some minority equity positions, platforms we really like, portfolios we really like, but really trying to keep it such that we're finding some interesting and attractive and very diversified portfolio positions. At the same time, we're not going all in onto equity just yet. So we are keeping some dry powder further up the cap stack in junior triple Bs, in fact, because we find that double Bs right now are trading either too tight or not cheap enough.
Is what you're saying that the fundamentals for equity are improving, or rather that the prices have been beat down to the point where it's an attractive entry point given fundamentals that aren't that attractive?
I still think it's more the latter. It's not necessarily because the real issue is, as we know, the arb to create a new CLO is pretty dismal. So that's not attractive. And I think that the interesting part when you take a look at the leveraged loan market, it's been roughly flat at 97 year to date. But the one sector which has really traded off significantly, it's going to come as no surprise, is software. That is down 5% year to date. So it's been trading in the 91 to 92 range. And then you have the subset, which is horizontal software. So that application type of software, and that's trading around 89. There is still significant dispersion, and there's still significant bifurcation in the leveraged loan market.
Well, to buy equity expecting a pretty favorable outcome, do you think you need to have a positive view on software and the outcomes of these loans?
I think the initial sell-off was certainly one in which we would say was the baby being thrown out with the bathwater. Over the past few months, there's been a significant amount of analysis of software. We know that software accounts for 16% of the overall leveraged loan index. So it's going to be a big one. The difference with high yield is that it's only 3%. But here's the kicker. This is the part that's really interesting. 95% of leveraged loan software is rated single B or triple C. It's only 5% that's rated double B. I don't think that all of them are bad, but there's a really high probability that you're going to get increased defaults and lower recoveries, I think, in software. But it's not just kind of software. And I think this is the real issue that we've been seeing in the leveraged loan market. And certainly as we're taking a look at risks and portfolios, everyone's focused on software. It's not just software. It's actually AI disintermediation. And this is what we're really focused on. It could be ever since ChatGPT came out a few years ago, we've been looking at what is going to be the impact of AI on credits. Because when you're taking a look at going to the doctor, are you going to allow the doctor to record your visit? Is it going to be transcribed? Doctors would love to utilize this technology. The problem is that it's not always accurate. So you kind of need to have accurate medical files, and you don't want to suddenly be in a situation where something incorrect has been transcribed or something incorrect has been prescribed. So those are two things that are incredibly important. And that's why taking a look at medical is an interesting one to look at, or even legal, when we're taking a look at the impact of AI on it and whether or not it's classified as software or is it being classified as healthcare or legal, i.e. business services. The actual impact of AI disintermediation is really what we're really focused on, because it's what does it mean for a company? Is there a real reason for them to exist? And we find the real risks are for those companies where a company that maybe is using an external software vendor, when they're saying, okay, it's now time to bring that in-house because we can actually do this now in-house because of an AI feature. That's the real risk. It's about to say, well, actually, in the case of healthcare and you going to your doctor, HIPAA is going to protect you. In the case of legal, whether it's court documents, dissertations, etc., having a transcribing service would be fantastic, except they also make mistakes. The problem is you need in the courts, you actually legally need to have accurate note taking. That's why you have the stenographers and not necessarily AI, which is just transcribing it. So that becomes the real issue. The level of accuracy needs to be so high that there is what's called, as you know, moats. There's legal reasons why these companies have a reason to exist and why they will actually continue to remain in existence versus other software companies, which are considered horizontal. That's those software risks that are going to be, again, that's the type of company that could be displaced by AI. That's the company that doesn't necessarily have a reason to exist. And those are the ones that we're really, really seeing massive pressures on. They're not trading at 89. Those are ones that are trading anywhere at 40, 50. Those are the ones that are really at risk. And that's where we definitely see there's a significantly higher risk of defaults and much lower recoveries.
When I talk to CLO managers, I think the general summary view would be that most of their software loans they think are going to be fine.
Oh, yes, everyone says that.
Yeah.
I was about to say, yeah, I talked to a CLO manager and they have high conviction on those names. There's quite a few. And by the way, if it happens to be a CLO manager that happens to also be a PE firm, they have high conviction.
They have high conviction on that.
They have high
for
conviction.
sure. I think they would say AI is certainly going to create some winners and losers. Although they might feel generally good about their portfolio, there's going to be some incremental defaults from software-related loans, and the defaults aren't going to be this year probably. They're going to be maybe it's late next year or the year after. But what's happened is it's just kind of another negative for equity in that we came into the year with a declining default rate, and now we have this overhang. And the derivative of the overhang is that there's not enough, in my opinion, loans created in our market to satisfy the demand, and that results in loans, as you know, repricing tighter. And if software loans aren't bankable, if PE firms aren't buying them in LBOs, and if anything that could have this AI risk in it, if these companies aren't bankable, it's going to be a lot less supply created in our market this year.
Yes, that is true. But I think you need to kind of put it into that bigger context. So when we take a look at, you're right, software has been the biggest issuing sector for the past few years. That fed, obviously, the demand for leverage loans. But you do always have other sectors which have been the biggest issuer. And I think this is, again, software technology, they have, let's call it 16% or so exposure in leverage loans. But when you put that together, oddly, with private credit, it actually is a very large concentration. But it rivals that and somewhat exceeds that of telecoms in 2000, autos 2006, and energy in 2016. As you very well know, when you have this massive issuance in a sector, typically that's going to be the sector where you're next going to get your highest level of defaults and initially lowest level of recoveries. That's exactly what happens. So we've been kind of waiting for software to happen for a while because it's really been dominant. But it doesn't mean that you don't get another sector in the next few years that is going to be the one that is going to take over as that higher level of issuances. It could be, let's take a look, where are we geopolitically? Every country needs to arm itself. Every country also is looking at energy, believe it or not, energy self-reliance. The biggest sector that issued was energy in 2014-15. That was a massive, massive blowout. What was interesting there, and I know more about offshore drilling than I really ever wanted to. Nonetheless, what's kind of interesting about it is this kind of cleans the cycle out. It gets that froth that was in that particular sector out, and you get those over-levered companies and they go into bankruptcy. We've kind of had this a little bit along the way, as you know, post-COVID. We've had liability management exercises over the past few years. When you keep into taking a look at distressed exchanges, et cetera, to your point, In January 2025, we did have a default kind of in that 4.5 context. That's gone down now. Exactly to your point, 180 basis points. I think this month we're actually a little lower. So we're maybe, I think it's actually about 2% lower. So we're around 2.2% right now in leveraged loans. That really does mean that when you're looking at, to your point, we're in this nadar right now, almost seems, with defaults, but it's going to pick up, and it's going to definitely be picking up with that software. And we are going to be taking a look at, I think, lower recoveries because of the sector. But it doesn't mean that the market stops. It kind of slows down a little bit. You get some better quality companies that are going to come to market. I could see infrastructure. I could see oddly renewable energy companies. I could see a whole lot of different types of sectors that are going to be focused on really where the growth is going to come from. And that could be from a variety of different ones. Housing, maybe not housing directly, but you're going to get growth. And we're going to see that CapEx over the next few years.
Okay. I think our market has coalesced around the idea that recoveries in software won't be favorable. And the primary reason, what you said, was that these businesses are asset light. But the flip side of that is that they do have historically decent retention of customers, favorable free cash flow generation, meaning people pay for software up front and there's no CapEx. And also, the businesses are somewhat easy to understand. Not all of the borrowers and CLOs could you say that about. Given the cash flow characteristics of these businesses, is it possible that actually recoveries might come in more like historical, or you seem skeptical?
I'm skeptical a little bit simply because we've been seeing recoveries coming in pretty low, more in that 10 to 20%. But we also know that the companies that end up defaulting first tend to be the ones with the lowest recoveries. So that's just something we do take into account. I know the historicals, and I think this is to your point, and we actually take a look at the historicals. We did find that we had between 2023 to 2025, so that's 3 years, average recovery rate, 70%. Year to date, it's down to 60%. And the reason it's really down to 60% is because of the LMEs, because the other issue is that 60% of companies post an LME actually do go into default. So that's just part of it. And those tend to have lower recovery rates of about 50%. So it's those companies that are dragging the recovery rate down in general. And I think that's where you have to put it in perspective. Again, not all the defaults that are going to happen are going to be in software. You may get software that's going to be anywhere between 10 to 50. That's not zero. So let's put that into context. And we do anticipate, again, generically, the recovery should be in that 60 to 70%, what we've seen historically.
So one thing that's been in the news this year quite a bit is redemptions from private BDCs and from interval funds. Investors in retail seem to want their money back. Institutional investors, my understanding is they're continuing to allocate. They don't maybe see the issue, but how do you see redemptions as affecting your business or the loan market in general?
So far, we really haven't. A lot of the structures, to your point, when you're looking at those redemptions, they have been predominantly focused on private credit. The BDCs, if they need to take a look at selling something, they do have segments for the most part, which are more liquid, and they are able to sell those. So they can take a look at doing those. Those that are focused, let's say, more on just CLO equity. Well, I did mention 1.9 billion of CLO equity hit the market in May. So maybe somebody was raising some money there. So that's quite possible. But again, when we're looking at these redemptions we've seen in private credit funds, that's very specific. Private credit, and it's one of the reasons we don't invest into private credit CLOs or middle market CLOs, they're illiquid. They tend to have a very small syndicate group, typically 3 lenders. And that's not going to create a very liquid secondary market typically. We recognize those are very specific. We also recognize that it's the same thing that we've seen since COVID with commercial real estate. Those are illiquid underlyings. And this is why you've also seen real issues in private equity funds. They haven't been able to exit out of those credits. They're illiquid. The difference to CLOs is that CLOs are liquid. So if you want to go ahead and sell any position across the cap stack in the CLO market, you can do so and it will trade T+1. That is not a feature you find in private credit, real estate, or private equity.
So you're investing from the entire stack, I mean, AAA down to equity. Is there one security that stands out to you as offering particular relative value today?
We have been buying CLO equity. When you find that much hitting the market, you can pick and choose where you find it. The other two tranches we like are junior triple Bs, and that has to do with the fact that the NAIC is considering increasing the risk-based capital charges for junior triple B tranches. As a result, your insurance companies, which are by far your dominant institutional investor in the CLO space, definitely has been migrating up, let's call it, into your AAs and your single As. So your AA and single A tranches have been trading very rich, and that's because insurance companies are yield-based investors. So they find a yield, and in this higher interest rate environment, they've hit a yield bogey. That's it. Simple as that. So they're buying your senior triple Bs, they're buying the single As, the AAs. They just hit a yield target, and they're buying it. So we think they're trading very rich. We do like the junior triple Bs because you're anywhere between 100 to 150 basis points back of your senior triple Bs, and within about 100 to 150 basis points of double Bs. And we think that's attractive. So again, we are targeting very specific deals, specific managers, and as a result, that works for us. But we do realize that we're not going to run that up. Very specific. And then we also like the AAAs.
How would you say the education process has changed, and what's the relative knowledge? How has that changed for your typical investors in your ETF or your interval funds?
It's been a huge, really quite fascinating process over the past 4 years. We launched CLOI with FANEC 4 years ago, and the first 2 years were about educating the financial advisors about what was a CLO, how it was different from an ABS CDO, why it wasn't the product that brought down the economy in 2007. There was a lot of that going on, and that was really important to talk about this differentiation, the fact that CLOs are transparent, the very fantastic default history, et cetera, since 1992, sending over the S&P data, the Moody's data, all of that, and showing just how absolutely robust the CLO structure is, and particularly post the GFC. And that's actually really important because, as you know, it takes time. It takes time to educate the investor base, and that's institutional investors as well. So let's be clear, despite the fact that the CLO market is in the United States over $1 trillion in size, you still had institutions that did not invest into the CLO space. The fact that retail investors didn't know much about CLOs, it shouldn't come as a surprise. First of all, they were barred from investing. And then second, even your institutional investors were not actually investing either. So it's been an educational process over the past several years. But those first 2 years, we would educate. And the last 2 years, it's more about how do we allocate to CLOs? Which are going to be the products that are going to benefit our investors? And honestly, since COVID, it's actually a very easy investment story to tell because many fixed income professionals have a benchmark against the ag. The ag's awful, just really bad. It doesn't matter. I have investors globally who say, well, can you beat our benchmark is the global ag? And I'm like, well, it's really easy to beat that. Let me help you. Because you can. You can, in fact, when you look at the Sharpe ratios for IG, CLOs, it is so easy to highlight how you're going to be adding yield at lower volatility to your clients' portfolios. It's just so easy to tell that story because the data is there. And unless, because this is the whole thing over the past few years, everybody's been waiting for the duration trade. And the only time that IG beats being invested in a CLO is when there's a duration trade on. Everybody's been desperate to put that duration trade on for the last few years. They put it on in IG, they put it on in treasuries, they put it on in mortgages, munis, and it's fantastic for about 2 weeks, maybe a month. And then it sucks and it totally trades off again. There's nothing they can do about it. So they're sitting there going, this is awful. We want to deliver portfolios and investment ideas that are going to benefit our clients. And CLOs have been delivering. Again, what was the one fixed income asset class that performed the best in 2022? It was CLOs. It was investment grade CLOs. That was by far the best investment in 2022 when nothing in fixed income performed. When you lay the data out, the story does tell itself. Again, because of the size of the market, because of the fact there are ETFs, and they've been out there more than 5 years now in many cases, there's history. You can take a look, and a lot of investors now have a degree of comfort with CLOs that they didn't. And that's just on the retail side. Now, we're talking about the institutional side. And an interesting quirk about CLO equity opportunities, it used to be, was always third party, et cetera. But with risk retention funds, better known as captive equity funds, it's been, let's call it about 10 years that CLO managers had to trot around the globe or around the United States in order to educate institutional investors. So the interesting thing is that through this education of institutional investors, and we're talking family offices, global pension funds, sovereign wealth funds, pension funds, they too have now become much more savvy about CLOs. So that they're not just investing in the equity, they're investing in mezzanine tranche funds. And when you have that education level amongst that investor base, and particularly the family offices, this then translates again into your ultra high net worth financial advising teams, because those teams want to also be able to provide products for their clients that they want to be able to do that. And having CLO products that are really tailored, have the track record, et cetera, for those investors is also critically important.
So my closing question is always describe a CLO in 30 seconds.
All right, let's give it a go. A CLO is a securitization of leveraged loans, but it's a mistake to classify it or put it with other types of securitizations. In contrast, it's actually an actively managed collateral pool. It's a credit product. So from the debt investor side, we want assurances of rating stability, which we get through structure, performance quality tests, in addition to the investment guidelines. So all of this ensures a diversified portfolio. But as an equity investor, we're receiving term funding on a 10 times levered investment. As an investor, we're having the same exposure to the leveraged loan portfolio, but it's 10 times levered. So for us, manager selection is critical, but it always comes down to security selection, portfolio construction, risk management.
Laila, thanks so much for coming on the podcast. Really enjoyed it.
Thank you so much. It was a pleasure.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any FlatRock Global fund. All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities, or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such, or be the basis for an investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. Market volatility may significantly impact the value of your investments. Recent tariff announcements may add to this volatility, creating additional economic uncertainty and potentially affecting the value of certain investments. Tariffs can impact various sectors differently, leading to changes in market dynamics and investment performance. Copyright 2026 TCW.